Hey guys, Freaky Finance here. Today we're going to do a regional bank. So a fun one in the US regional bank, Truist Financial. Now it's not one of the small ones, one of the bigger regional banks. And we're going to jump into some history behind it. I'm a little bit sick, but that's okay. We're going to power through. I love going through banks because they're so simple and they're usually very similar. And the only thing that's different is where they operate. And in my mind, they are a very commoditized business, even though some of them are unique and special. Once you analyze one bank and fully understand how the business model works, it definitely helps it speeds things up when you go to the next bank. So your typical bank offerings, so checking, savings, credit, small business loans, mortgage, investments, sold off the insurance. We'll talk about that in a second. Where are they located? Probably the most important thing, mainly in the southeast. So where there has been traditionally been a population influx because of superior policy. Just some back history before we jump into more context. 2019, Truist was created between BB&T and SunTrust. So that was a top 10 commercial bank, headquartered in Charlotte, North Carolina. And basically, like most banks, you get the two main ways that they make money. In Truist's case, you get the net interest income derived from the loan and securities, and then you get the non-interest income from wealth management, investment banking, and payment business. So very standard. It's actually super nice. They actually sold off their insurance in 2024 in May, so relatively recently. They originally sold 20%, but then they sold the remaining 8%. It actually shot up their CET1 ratio by 200, so 2.3%, which is material. So the balance sheet looks very strong because it has sold off this business. It also makes it easier for us to analyze, so we don't have the insurance arm component that a lot of banks have, especially bigger banks. And that can make things harder to analyze. Whenever you think about a bank, this is probably the most important thing. It's a Wonderful Life because it's so good. This part where when everyone runs on the bank, right? And, your money's not here. It's in this home, and that's huge. Banks really do touch everything. And if everyone just swarm and try to get all the money at once from any bank, every bank would fail, right? It's not every bank doesn't just keep the money. What they do with the money is they lend it out. That's how they make money. So you bring in a deposit. Your deposit maybe makes a little bit of money, and they relend it out to somebody else to make more money, and they make money on the spread. That's how banks work for the most part. They'll also sometimes invest it so that they have some of it readily available, and they'll usually try to asset liability match. So if they know a certain amount of money needs to leave each month on average, they'll always make sure that they have enough on hand to accommodate that, whether with loans that are naturally maturing or with just having enough in their CET1 ratio so they have enough cash for anything they need. It's probably the most important thing right here. Like your money's not here, it's in this person's home and this person's home. That is what banks do. They do more than that. They help people just build businesses, whether it's buying a home, right, or even grow established business that already exists, right? So, and here's Gemini saying, well, next time you walk past a coffee shop or a crane building a new apartment or a local tech startup making waves, there's likely a bank behind them in some capacity. Always worth pointing out, right? And at the end of the day, one of the biggest things, one of the reasons why capitalism in America is so strong is because of the banks and the capitalist nature of lending to people with ideas and taking a risk. So that's probably like, if you had to understand the purpose of a bank, you could really from here you could build out what the balance sheet's probably going to look like. And they all look relatively similar. Some are different than others, but a lot of them, once you analyze one bank, you're going to see common trends over and over again. So on the balance sheet overview, most important thing. So I know the balance sheet's always the most important out of the three statements that we talk about, even though we don't spend a lot of time on the channel talking about it. For banks, it's paramount, the most important thing. Not even like the P&L, not even close. Cash flow statement is interesting, but balance sheet, if the balance sheet's no good, you're not buying that bank. So here you have a fairly standard split. So almost 60% of their assets are in loans. So that's loans that they sent out, which is different from, like, say, someone like me, like this house. Loan, the liability is mortgage, right? It'll be a liability side. But for a bank, they're lending money out, usually against the deposits that people have given them. So, and again, that's the main crux, is making money on the spread. So loans, a lot of it. Securities, quite a bit of it. We'll talk about what's in the security profile, so 23%. So basically, when they get the deposits from people, they can either lend it to other people with ideas or mortgages to build homes and infrastructure, or they can invest it in securities and try to make money that way. And usually it's just a cost of capital allocation equation. Deposits were interesting. There's quite a bit that's still non-interest bearing. Some people don't change, just kind of leave their money in a kind of just sitting around, not earning any money. That's really good for banks because it's basically the lowest cost of capital that they can have is where they don't pay anything on the deposit, right? And then they still get to make money on when they relend it out. So, but you can see 27% is non-interest bearing, a lot more is interest bearing. And then they also have their own total equity. They can issue their own shares. They have their own retained earnings over time because they are profitable. And then you have your own, they can also borrow on their own balance sheet as well on the liability side. So, and yes, deposits for a bank are a liability because they're accountable to give you your money when you actually ask for it. I should disclose before we jump into it that I do own this one. Truist down here. It's kind of shot up lately like a lot of other things. I was debating about doing that or Rogers, but Rogers kind of already floated away. We talked about Rogers before. Or UNH, but it was also kind of shot away. But anyway, it's still worth doing the video. This is actually some context of why Truist, out of the regional banks, it's one of the three during the tariff tantrum. I asked AI, like, what regional banks do you think would benefit the most from the big tax bill? And this one came up, interesting enough. So I don't know what the AI saw, but it saw opportunity. And then I looked at it and I did a quick analysis, kind of like what we're going through today. And I was like, okay, it just looks good. And it was at a relatively cheap price at a time when the markets were panicked, right? Anyway, so I do own this one. But let's continue on. So the crux, again, this is the loan side now. So if we drill into the assets, what do they actually loan out? A lot of it's commercial industrial. It's a big commercial industrial lender. Mortgage, residential mortgages is there, but it's not huge. It's huge on the investment side. They invest a lot into agency mortgage-backed securities, but on here for the lending side, pretty strong. And you're going to see as interest rates slowly come back down, you're going to see the average amount that they charge on their loans are going to go down. But on the flip side, the deposits, you're also going to see that go down. So the amount that they have to pay on their deposits is going to go down. And again, it's just a spread game. So you're basically always in this spread game. And usually there's a leg. So all the mortgage book, the loans, right, don't reset all at once. There's maturity dates. And it'll be very interesting to see how sticky the lending side is as the rates come down. It'll depend how quickly the rates come down. And one of the things that squeezed a lot of banks is how quickly the rates shot up because all their deposits got more expensive and their loans took time to build to that. And so now we're going to see the reverse of that, and kind of depends how quickly rates go down or not will really help these banks in a very short amount of time, which could make them actually outperform potentially if that were to happen. But if that were to happen, chances are something would be wrong in the economy. Then they'd have to increase their provisions, which is when it's my favorite time to buy banks, is when there's a panic. They have to raise their provisions a lot on their lending, basically to try to account for bad debts ahead of time. And that's the best time to buy banks. So that's when you'll see more bank videos. It's when people are afraid to buy them. But for now, this was just a good one to do. And it's always good to brush up on common banking themes. So basically the spread between the two is called the NIM. It's the net interest margin. And here you can see the split. So around 3%, slightly up from last year. But again, it's kind of flatlining, which is interesting. So I'll have to see how this sticks in. It's actually higher relative to most of the regional banks. So that is exciting, but again, part of it I think is because the spread is relatively skewed to commercial industrial, so I'd expect it to be a bit stronger, but that kind of depends on the loan book and how much is maturing at any given quarter. In terms of the investment portfolio, so the other side of the assets, 23% of them in here, 58 loans, 23% securities. You have AFS and HTM. So AFS is available for sale. HTM is held to maturity. You can see there's 73 billion available for sale and 50 billion for held to maturity. Now, this has always been a gray area for me because it really relies on intent. So in my head, I always think HTM means longer duration, but that's not always the case. AFS should be shorter duration than HTM, but that's not always the case. In terms of what they actually own, though, inside each of them, it's largely agency MBS residential, all this purple. So, and you can see this here, it sounds like a sore thumb on the 10K. You can see 50 billion here in agency MBS, another 50 billion here on the AFS side. The thing that surprised me, it was a weakness for them, is this HTM, 1.78% effective yield, that's really poor in my mind. It's actually horrible. So that wasn't a great find. That was one of the things I didn't like about Truist. Now, I mean, if I was trying to figure out, like, and at the same time, the duration's at 7, so I was like, okay, you have a duration of 7 exposure, and your effective yield is 1.7. It's not exactly shooting the lights out here. Some context. Here's just a better way in my mind to view the securities, and you can see it's dominated by MBSs. When you put AFS and HTM together, what are agency mortgage-backed securities? Basically, principal and interest is guaranteed by the U.S. sponsors, the GSEs like Fannie Mae and Freddie Mac. Now, the AI says virtually no credit risk. There's always credit risk, but that's not the point of this one. If that were the credit risk, I wouldn't be seeing the things that I'm seeing right now in terms of valuation for other companies. There's other things that would go first. HTM, so again, intentions to hold for the long run, provides stability and predictability. Now, there's a lot of accounting things in here. Basically, how I view it is because it's HTM, you don't have to mark to market. It allows them not to see the full hit when MBSs got crushed as interest rates rose, just like most fixed income instruments. And now as interest rates come down, they don't have to mark any crazy gains. They just amortize it as it approaches par over time. So it's very very friendly for the P&L for any type of earning swings, whereas AFS has a lot more noise, right? As reported, AFS securities report their fair value at the end of each reporting period, so every quarter for Truist. And now on one end, it's more transparent, but on the other end, sometimes the market gets panicked and it could put asset prices lower than ever, and these guys have to market to that. And that's when you get real opportunities in banks sometimes. As long as their overall balance sheet's fine, you can see material swings in their EPS. They get slammed. Sometimes at the same time that their provisions go up. And so you get really interesting dynamics where like banks become very no-brainer buys. That's not today, but that's sort of bringing up, like that's the time you're going to see a lot more bank videos from Freaky Finance's channel. The good thing about agency MBS is that they are pretty liquid, and you can basically, what you're doing, and the AI is right here, agency MBS offers significant yield pickup in exchange for taking on prepayment risk. Prepayment risk is just if you start prepaying your mortgage quicker for a home, is actually a risk that you're a good steward of capital and paying down your debt ahead of time, because it takes away the return. It's called negative convexity, but we don't have to get into that. That won't help us make money on this trade. Every bank has this taxable equivalent net interest income, or some equivalent. If you didn't have all those fancy pie charts, this is what I go to. It's probably the best, most important thing on the 10K of the 278 pages, page 54. way super important. Just get the balance sheet. So snapshot, what's in the investments? What are they lending? Where are they lending? What are the rates that they're lending at? What are the rates that they're making money on their investments? And compare that with the rates that they're paying out in deposits. And basically, that's how the banks make money. So they lend home equity at 7.9, and they only have to pay time deposits at 4. And they have to borrow for themselves at 5%, but they can re-lend it out on their credit card side at 12. Stuff like that. Or maybe they park some non-interest-bearing deposits, and they're like, you know what, we could just invest it in case they do decide to pull money out. They can get money quickly. So that's kind of just the game that I look at, is just seeing how are the trends going in this. You can see as higher rates shot up, their investments started making more money, even though the prices that they would have paid would have went down. So that's one of the fun conundrums with interest rates on the investment side. And the loans, however, take longer, usually, unless they're variable. But usually they have to step up over time and follow the rates on a leg. I was surprised to see that the residential mortgages only went up from 3.6 to 3.8 on their total book over the last 2 years. Tells me that the pricing of mortgage has been very slow. So a lot of the, partially because in the US, the terms are longer, 30 years fixed. We don't have that in Canada. So I was kind of surprised to see how low this shot up relative to what the rates did, right? You can see how the rate shot up on the commercial and industrial side from 3.9 to 6.3. And as rates go down, these will go back down, but so will this. And the idea is just to make money in between the two. There's the NIM right there. So that's probably the most important line, most important sheet for a bank, is just what assets do they have, how much money do they make on it in terms of percent, and then how do they get the money that they have, and what are they paying on that. In terms of asset quality, this is the most important. Usually in a presentation when I'm looking at a bank, this is usually the most important, because what I'm trying to do is find the rate of change is, okay, did their provisions accelerate not only more than usual, but in line with other periods that were obviously buying opportunities for banks. We're not here yet. Usually you see the provisions shoot up more than normal. That's not the case here. And that's usually when you get an opportunity to buy, because usually that's the only time the market and the banks are forecasting something that's worse than what's currently happening, is usually during that time, because this is the banks basically providing for losses ahead of time. The market also forward looks. So usually when the provisions are shooting up is usually when the markets are already, well, but what I should say, the best snapshot of time is when the banks are still reacting to the credit provision cycle. So the multiples are still depressed, but the markets are starting to accelerate again. They've already come off the lows, and usually you get a lagging like the last quarter. So the markets have already risen. Say they bottom in March. You're not sure that it bottomed, and now it's in April, and things are looking better. Most things are up 10% or something, and then they're gonna report their earnings, and they're still gonna have these high provisions, and usually you get this little weak sell-off on the earnings call, and then you just buy them because the cycle's already gone through. That's usually the best in my mind. It's like the windows of snapshot windows. I don't know, that's a term for me anyway. Oh, set one ratio, super important. Again, it shot up recently because they sold the insurance arm, so they actually have more cash on their balance sheet than normal, or than most other regional banks. These ones are more in line with the big guys, JP Morgans of the world. When our earnings season starts, usually in the middle to end of April, July. Next quarter will be fun. JP Morgan and BlackRock usually set off my earnings season. In terms of one of the important things that I also look for at banks, just to know why Truist, again, it was trading cheap at a price to tangible book value at the end of 2024. Importantly, the efficiency ratio has always been relatively strong, 57.7 versus the rest of the other large, but not mega large, like no JP Morgan or Citibank. Maybe what I mean by large is the bank's diversified. So JP Morgan, Bank of America, Wells Fargo, this is by market cap, just the size of the square. And those are way bigger than any of these little regional banks. So there's Truist right here, right? And so it's just screening relatively cheap to the other ones in this category. So that's worth bringing up. And then again, more why Truist, the efficiency ratio. So the efficiency ratio is basically just how profitable and well managed the business is. So you just take your non-interest expense divided by your net revenue, and the lower number is the better number. And this is what AI's opinion, what a good efficiency ratio is 50% or lower is considered optimal, 50 and 60 are seen as good, those above 70 are cause for concern. I think that's fair. It kind of depends on the bank, where they are, what they do. Some of them will do different things, right? Some will have more insurance, some might have more car loans, percent of their sales, right? Some might have more HELOCs, some might have more credit card. But anyway, they all kind of affect this model, right? But usually you're going to see banks, one of the really things that banks are doing to get this efficiency ratio up is actually reduce the number of branches. And that's one of the things we're seeing, like in, say, the Robinhood of the world. I know sometimes that's crazy to look at, but one of the reasons why is it's really an online bank is a lot less cost, and you're going to see efficiency ratios much higher over time as the traditional banks slowly get taken out by technology, right? Because the younger generation won't go to a branch. They don't really have a financial advisor. I mean, some of them just use influential people on YouTube. So that will change over time too, which is something to think about down the road if we get an opportunity at Robinhood, or we talk about Wealthsimple through Power Corp. But anyway, one of the reasons why is like this was a while ago, like Truist for the tax bill. AI thinks specifically the tax bill will improve EPS for Truist by 4.8% year over year. Very accurate. We'll see if that's true. I won't hold the AI to it. We're Gemini in this case, but it does back it up pretty well. It does say that there's a proportionate advantage to smaller banks over the big banks. The tax bill does pass, which does help the regional banks. And we might see some asset swings from the large banks to the small banks, or we might see the big banks just buy more small banks, which has always been the case for the last, I don't know, since I've been studying the markets. But I'm not that old. The ACRE Act, basically banks exclude from taxable income portionable 25%, the Senate version currently, of the interest income earned on qualified agricultural real estate loans and rural housing mortgages. So this is basically to help the farmers and rural houses in America. This is something that will be a big boon to a lot of regional banks that have a lot of lending in agriculture or land. Like, think of where they lend to. Is there a lot of farmland in this southeastern area? kind of. It's not like the Midwest, but there's still a lot in Texas, and there's still a lot in general that would benefit from this. And that's a lot of loans. That's not agriculture real estate loans. That could help a lot of things. This AI doesn't bring up auto loans, but I mean, if auto loans is not deductible, then the banks can lend more to people and make more money off them, which may or may not be in their best interest of the end user, but that's something that's likely to happen, right? And then AI does bring up that banks with more rural footprints become M&A targets for the big banks. So that's worth pointing out. It does try to break out like the impact on the big banks like JP Morgan versus Truist, regional banks. Anchor Act highly positive, targets rural ag lending, core business for many regionals, but a niche for the big banks. Section 199A preserves the viability of the S corp structure. I mean, it's kind of, that was in question. I'd be more more scared if it wasn't. International tax is kind of not as good for regionals actually, because they're not there, but it can help for the global operations. R&D for everybody and bonus depreciation we talked about. Banks do have to spend a decent amount in R&D, so having this ability to expense it all for tax purposes will actually help them, as will the bonus depreciation if they are investing more in branch networks and tech infrastructure, which they will be as well. So it does help these guys as well. It's not as obvious as what we did for Amazon and Google, which are big overweights still for 2025, because those in my mind are by far in a way like it's not even close how much they'll benefit. Set one capital, we talked about it a bit. It's the highest quality capital bank could hold, and basically it's the absorption loss, so the loss absorption from retained earnings and how much cash they have on hand. So it's how much of it is readily available to absorb losses. And this is an important balance, and you're going to go back and forth. And I think on the Republican side, you kind of want it lower because they want lending to be easier. So technically, the higher is safer, but it can make things more frictionless or more frictionful when you want to lend or when you want to borrow. The bank are more likely to say no with a higher set one. But if you are able to lower it, chances are your efficiency kicks up. You don't have to keep as much dead cash on hand as a bank, and you can lend out more to more people. So it actually helps lending, and technically would be a boon on the economy. So you'll go through these cycles of where the regime is regulation heavy and it hurts the banks, and then where it gets lighter and it helps the banks. And that the main thing is just rate of change, especially in that year over year that it happens. So that's why we're looking at regional banks, because this will actually help them. It may not help the overall health in the long run and when there's another stress, but honestly, it kind of depends on what the stress is anyway. So this will be interesting to see how this plays out, especially in the larger guys, because it actually does help them as well. And it's one of the reasons why, if you want to know, like during the Great Financial Crisis, we were still able to buy a Bank of America at $5 in 2011, 2 years after the low of March 2009, right? The banks were still this cheap, partially because they're ground zero for the drama, but also because of the regulations overhang, right? They're like, okay, the banks are going to be crippled forever. That was like the thinking at the time, like they'll never make as much money as they did before. And that turned out to be false, but that was the thinking at the time, right? And so regulations could have meaningful impacts on valuations in terms of rate of change. So that's what I'm trying to bring up here. So anyway, what else could I say before I close out? Truist does have some agriculture programs here on the residential mortgage side. I just think the current setup will help banks a lot for lending. So it'll help actually lending the velocity of money. And the deregulation will help getting more money out to more people, which should actually accelerate the economy when this happens in the back half of 2025. It's worth pointing out. Now, it doesn't mean it ends well. Usually it'll be when the next person gets elected, they'll reverse some of it, and then it'll slow things down again. But you need to be sensitive to that rate of change and when to look at regional banks, and maybe not. And this looks like an interesting time, right? Especially with the Acre Act for agriculture. If you have enough people and our large corporate clients that are invested in agriculture in some way, or rural development housing, right? It will help you out a lot as a bank if you're lending to those based on this. And then you also have the auto loan exposure, well, indirectly here. But anyway, just things to point out. It's definitely an interesting time. It kind of sucks. I always hate doing videos when like we're constantly making all-time highs, or it feels like it. I know some people are only up 5% this year, but it's just a crazy time. News changes every day. But yeah, I'd like to know your thought on Truist. If you have any regional banks you want me to look at that look relatively cheap, I'm always all ears. They've kind of recently shot up a bit, but I'm always interested to see people's takes on banks and why this bank over that bank. It's always interesting. And yeah, have a great rest of your week.